Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. Today is 2026, June 26th, and the AI trade is acting like a treadmill at full speed. Some investors are sprinting, some are flying off the back.
So basically, Wall Street bought a gym membership called artificial intelligence, and now the machines are judging everyone. I'm ready, but my portfolio is wearing flip-flops.
Story 1. Micron Technology delivered blockbuster fiscal third quarter earnings and record guidance, according to Market Pulse, helping global technology stocks rebound in Asia. The key driver was strong demand for high bandwidth memory, or HBM, the specialized memory used in AI data centers.
HBM sounds like a fancy gym class, but it's really the snack bar for AI models. If NVIDIA is the chef, Micron is selling the fridge, the pantry, and probably charging extra for ice.
Exactly. The simple finance version, AI infrastructure is not one stock. It is a supply chain. When cloud companies build more AI capacity, they need graphics processors, memory, storage, power, cooling, networking, and a balance sheet that can survive the electric bill.
Why it matters for normal people. If you own broad index funds, retirement accounts, or tech-heavy ETFs, you probably own this story indirectly. The opportunity is real, but buying after a vertical rally can be like chasing a bus while holding coffee.
Story 2. The New York Times reports OpenAI is leaning toward delaying its IPO until next year. Advisors are reportedly urging a slower approach after volatility in SpaceX shares and as OpenAI works through financial challenges.
That is the startup version of saying, let's not take family photos while the kitchen is on fire. Everyone wants the IPO party, but apparently someone looked at the spreadsheet and heard horror movie music.
Here is where I disagree with the panic. Delaying an IPO is not automatically bad. Sometimes it means management would rather strengthen revenue, costs, and governance before asking public investors to pay premium prices.
I'll push back. Waiting can be mature, sure, but it can also mean private investors are still using fantasy football math. If the business is eating cash faster than a teenager eats cereal, public markets will ask rude but useful questions.
Story 3. Chicago Fed President Austan Goolsbee told CNBC inflation is still too high, while New York Fed President John Williams has seen signs price pressures may be easing. Translation: the Fed is not singing one simple song right now.
The Fed is basically a group chat where one person says, we're fine, another says, we are absolutely not fine, and everyone else sends a chart. Meanwhile, mortgage borrowers are crying in spreadsheet.
For personal finance, the message is practical. If inflation stays sticky, interest rates may remain higher for longer, which supports yields on cash and short-term bonds, but keeps pressure on credit cards, auto loans, and floating rate debt.
So the action step is boring but powerful. Pay down expensive debt, keep emergency cash earning something, and do not treat a possible rate cut like it is already in your bank account. Hope is not a budgeting app.
Story 4. Semiconductor announced a $7 billion deal for Synaptics, positioning it for what it calls a physical AI push. CNBC noted the company says the deal expands its total addressable market by $30 billion to $243 billion by 2030.
Physical AI is when the robot stops being a chatbot and starts touching your thermostat, your car, your factory, and possibly your patients. It needs sensors, connectivity, edge chips, and fewer PowerPoint slides saying synergy.
This matters because AI is moving from screens into devices, vehicles, industrial equipment, smart homes, and healthcare tools. Investors should watch whether acquisitions like this create real margins and customer wins, not just bigger market size numbers.
And that brings us to the market wrap. Bloomberg reported tech volatility pulled global stocks lower again, with chip makers under renewed pressure and OpenAI IPO concerns weighing on sentiment. So yes, AI is exciting, but it is no longer one giant group hug trade.
That is the key reversal today. Earlier this cycle, investors bought almost anything with AI in the sentence. Now the market is separating companies with revenue, pricing power, and supply chain advantage from companies with only a shiny slide deck.
Quick recap. Micron shows AI demand is real. OpenAI reminds us valuations need oxygen. The Fed keeps rates uncomfortable, and ON Semi is betting AI gets physical. My portfolio has learned one thing. Enthusiasm needs a seatbelt.
Before you trade on any headline, ask 3 questions. What cash flow supports it? What price already reflects it? And how much of your portfolio depends on one theme? If this helped, subscribe to BD Daily Finance News Podcast and tell us in the comments, is AI still an opportunity or is it becoming overcrowded?